week. Infrastructure spend, but apparently we're getting close this time. Let's bring in our next guest. Dryden Pence is the Chief Investment Officer at Pence Capital Management. Dryden, welcome to the show. Are we actually going to get something real here this year? And can one base investments on that around infrastructure, or is it still just a political gambit?
Well, Oliver, thank you for having me on. And I think that we're in a position now that probably we're going to get an infrastructure bill. Now, it probably won't look like the one that's out there, the much touted $2.1 trillion. And if you looked at that bill, even that only had about $800 million. It's purely infrastructure in there. But I think that both sides have recognized this is absolutely essential. I mean, we have over 171 million crossings every year, or every day rather, across structurally deficient bridges. And our bridges in this country are in perilous shape, and we have to spend the money. And so I think both sides can agree on that. And if they can whittle it down to that, I think we're highly confident that we're going to have an infrastructure bill. And that's very important. And when you think about if you just took all of the dangerous bridges and you stretched them end to end, they're going to go from from Las Vegas to Seattle. And if you took all the ones that need repairs, that's just going to go from New York to Los Angeles and back again. It's a tremendous number, and we've got to do something about it. I think people have finally woken up to this issue.
So as we see from a chart, the graphic that you've given us here, the number of bridges, there hasn't been a lot of repair done. It hasn't really changed much. And clearly this is a place where it seems maybe just kind of intuitively we need an update. But what is an investor to do? Buy a bridge ETF? How do you do this, Dryden? If you think that real money is going to make its way into infrastructure, bridges, roads, or is this going to be a new style of infrastructure that is hyper like growth electric vehicle centered?
Well, I think, the fundamentals are you still need bridges and roads, and that hasn't changed in 100 years. And as the world spins around every day, they need replacement. So fundamentally, bridges and roads have to occur. Regardless of whether the car on them is electric or gas or whatever. Now, when you think about this, there's really only a very few companies that are qualified to do this work. And this is what we call the big noble theme is we need bridges. And the choke point happens to be that there are very few publicly traded companies that are qualified to do this kind of work. First of all, they have to get bonding, then they have to get government approval, and then and a lot of these are big joint ventures that they have to do. So you have about 8 or 10 engineering firms that are publicly traded. There's a lot of private companies, but publicly traded companies that you can, and then they have to get all their supplies, and there's only about 9 or 10 of those companies. So I mean, we can talk specifically about Jacobs Engineering if you want to talk about an example in that space. They're the 22nd largest government contractor. They have the most contracts with the EPA. So if you think about green energy and things like that, and what's happened when the government issues contracts, they go with who they know. And so there's only 9 or 10 companies that are doing a lot of this work. So you have whatever the number finally is, $800 billion is a lot of money, and it's running at this sector. And these companies tend to be small caps. They tend to be mid-cap companies. They're going to be more volatile. But if you think about the fact that a long-term big construction project goes for about 7 years. Once these things get started, they go for a long time. Then the companies that have them have long-term earnings potential that's going to last through a cycle. So we think about the engineering companies like Jacobs, there's some more. We think about the other companies that are the suppliers, right? Because not only do you have to engineer, but you got to get it. So, and they're going to go to the people that already have it. Somebody like Vulcan, because Vulcan already has significant producer of aggregates, right? You have to get the rock and gravel from somewhere, and the EPA is not going to be opening up a lot of gravel pits all across the country. So you go to the people that already kind of have the local monopolies, and Vulcan is one of the top 2 producers in most places. So that's an example. There's others, and people can look at those. But when you think about it, you want to look at the big engineering companies, and then you want to look at the suppliers. And then when you think of the smaller companies that are getting involved in this, they don't own millions and millions of dollars worth of equipment. They don't own their own tractors. They rent them. So a company like United Rentals spends a lot of time or a lot of their business is renting to the smaller contractors. So if you want to kind of think about how do you play all tiers of this market, you think about, give me a big engineering firm, give me a big supplier of aggregate materials, and then give me somebody that everybody needs to use regardless of their size. And that's the equipment that goes into them. Again, $800 billion is a lot of money. It's being thrown at a sector that is really dominated by just a few publicly traded companies. They're all going to get their share. Now,
right now, a lot of money coming to them if we get this deal, but also a lot of money that's gone into them on the stock price, too. I mean, I'm looking at URI up 200% over the last several years and way, way above where it was pre-COVID. I mean, this thing's just gone straight to the moon. It's beating the heck out of the industrial group. Jacobs and VMC doing solid as well, as those are also at multi-year highs. Is the market not moved already ahead of this, or can you still squeeze some juice out of these trades?
I think in the case of looking at each of these companies, it's important to think about the long-term quality of those earnings. And while the market's been volatile, again, remember these are small and mid-cap stocks. So you saw this bid go into that part of the market, and they were carried along with it. But if we move to the fundamentals of these companies, we're beginning to see a point where they're going to begin to have a lot of demand for what they do. So I think that if you think of, basically it does look like it has legs. You're going to see, while the pricing may be a little bit ahead of itself, the earnings are going to catch up to it, we think, over time, because you have this tremendous amount of money that's finally hitting this sector, and you still have state and local governments that are funding it a lot as well. So my answer to your question very clearly is we think it does have this movement continues to have legs, and the legs will be fairly long, because once you start a big project, it goes for 7 or 8 years. And these are well-paying jobs, and they make big difference. And it's good for the economy overall, because the average household, there's estimates out there that, just infrastructure and roads and inefficiencies and potholes, and it costs the average family about $3,000 a year, and that's a lot. And so if we can improve that, I think we move it across. So I think these companies this is a long super cycle of infrastructure rebuild, and these companies are going to benefit from. And the barriers to this is the other thing that people miss here, Oliver. Barriers to entry to this business are really high. It's very difficult to kind of get on the bid list because you have capital requirements, you have bonding requirements. A lot of these are done as joint ventures, so it's really a limited group of folks
money
that
coming
are playing in this bond.
Not too many players competing for it, so stick with the ones with the head start. All right, Dryden, message well sold. Appreciate it. Thank you, Mr. Pence, for the thoughts here into the closing bell. Dryden Pence, Chief Investment Officer at Pence Capital Management.